Now, this is going to be the big problem area. Unlisted investments, unlisted trusts, unlisted companies. I might just break it up into two different groups. You've got your, what would you call it? Your sort of smaller unit trust type situations. The ones where bunch of mates or business associates or whatever. They're basically using a unit trust to pool money together to invest in something. Primarily commercial property, it seems. Possibly some sort of business or like a development type thing, but that's not so common, or another investment of some sort. But like I said, primarily property. I'd have to say that that at least half of these unlisted investments we're doing are of that category, and probably a lot higher than that. And they have their own sort of special rules compared to the other, the big widely held unit trusts. And so, what do you as an accountant need to provide us to make sure the audit goes smoothly for these ones? And look, the first one is the financial statements. We absolutely need to see what's going on. They need to be signed as well. The ATO have recently clarified that on their website, that we can only use signed financials, and that gives us an idea as to what other audit tests. Now, if the main asset is property, the expectation is that what I talked about with auditing property in the previous section, well, it also applies to this too. There is an expectation that unit trust will actually go out and obtain a proper property valuation with comparatives. Once every 2 to 3 years, and then in the intermediate years, we do that. We could sort of, or the accountant can sort of adjust that figure accordingly. Now, obviously we start off with the financial statements. We replace property at cost with property market value, and you can come up with a value fairly easily. So it's not too hard. But a problem area has been obtaining valuation information from the investment manager of that little trust, and it's you might have 10 investors, and the investment manager pushes back and said, well, no, we're not going to spend money on a valuation, and so it sort of falls back to the trustee, and that creates a problem, because we as the auditor, we expect that valuation to be done, and the SMS trustee sort of say, well, why am I doing it for all these other investors? So look, it's a problem area, but just be aware that is our expectation. Now, another sort of subclass of these smaller unit trusts are what we call sort of semi-related trusts, which is say 3 directors of a business, and again, they've pooled their money, bought a commercial property, and their business runs from this property. So they're not Part 8 associates, in a sort of a black and white test. They don't get caught by that, but they're still sort of semi-related. And obviously, as you can imagine, the audit requirements ramp up because of the potential for, I guess, mischief, or not behaving in an arm's length manner. And so what do we need beyond the financial statements, beyond possibly a property valuation? Well, we'll need bank statements. We actually want to see the actual transactions, make sure there isn't any sort of loans to related businesses and things coming from there that are perhaps a bit non-commercial. We basically want to scrutinise the transactions of this trust to make sure everything's above board. And look, in a similar vein, you've also got 13 22C unit trusts, which are related trusts. And again, we need the bank statements, we need financials, and we need any sort of valuation information you've got. And so and look, at this area, to be honest, these small unit trusts have not been a problem for us, because I guess the thing is that the investors, because it's a bunch of sort of mates or associates, whatever, they can actually get access to the things we need. Sometimes a bit tricky with bank statements, but generally it hasn't been a big issue. So these trusts tend to be not so much a problem for us. Where we run into a lot of difficulty, is these big unlisted unit trusts, and companies and things, and it includes things like sort of semi-managed funds, which are only open to sort of wholesale investors, but their accounts aren't audited, or startup type entities. And essentially, the problem with these types of investments is that there tends to be a shortage of information. And say, for example, financial statements, they may or may not have them audited. The actual contents of the financial statements can often be meaningless. They're sort of, they're like sort of 40 investors and they've all put this money in this one thing, and then this the investment of the company they've invested in then reinvest in some other company that you have no idea, and it's all extremely opaque, and there's just no information available. So that's a problem. The investment manager doesn't want to get involved and sort of says, suck it up, and then on top of that, there are no recent sales. I mean, in these sort of situations, it's very difficult to come up with any sort of valuation methodology that works. And often, particularly for the startups, not making any money either. So you really don't have a lot to use. Now, stepping back for a sec, what are the types of valuation calculations an accountant can do before giving it to the auditor? And look, it's the standard sort of stuff. You can use income capitalization. If there's property there, usually where you get these large investments or large companies and things that have invested in property, they themselves are getting their own valuations periodically, maybe for bank purposes or whatever. But they are revaluing things, so that's generally not a big issue. But that's the kind of stuff. What else? The gold standard though is share sales. If this entity has made a share issue, or there have been sales between investors that are unrelated, that's the gold standard, and it's very strong evidence that can be used to support evaluation. But like I said, it's quite uncommon to have that. Whether it's a startup or a business been running for a while, and so this is going to be an issue. If a company has been operating for a while and it is making regular income, it's basically your typical business. A capitalization of earnings can actually work. And look, I guess the sort of the way to approach the valuation of these unlisted entities is it's similar to the 100-point thing you do when you go to the bank, where you get a passport or something. It's you've got to try and rack up points, and like I said, you've got the comparable sale. That might be like 80 or even 90 points. Then you put the financial statements on top of that, just to make sure nothing catastrophic happen. We can get over the line. Where you don't have that, where you go, well, okay, you've got it's not making any profit, and it's the financial statements are meaningless. You may be in a situation where you simply can't get any valuation, and look, we apologize for this, but like it's just if it doesn't meet the requirements, the ATO doesn't have a thing where they go, well, if you come back to the auditor and say, oh look, we can't give you one, we're just going to keep it at cost, it doesn't work. You have to meet these requirements. As I said before, they don't budge on these things, and they have high expectations. What else?
So Chris, I thought I might just interject. You're doing an extraordinary job, just going through everything. And for anyone who hasn't done a webinar like this, it's quite a big achievement just to be going through so much content and just sort of speaking through all of that. So I just wanted to give you a water break, Chris.
Yeah, no, I appreciate that.
And to also just use it as an opportunity just to maybe fire through a question that's come through.
Sure.
So we've had a question relating to Division 296 tax, asking, is it beneficial to have a higher valuation as at 30 June 2025 for a member with a balance over 3 million?
Okay, look, that's a tricky one. So
it's a curly question.
Yeah, with my auditor hat on, I'd be saying, well, the value is what it's going to be. You're going to get the value, and that's what it's going to be. With a sort of more financial planning / accountant hat on, the answer to that question is it depends. The sort of commentary I've seen within the SMSF audit industry is that the vast bulk of people over 3 million will be trying to increase the value, because it Obviously, it reduces the liability. When that asset's sold, they're basically trying to bring forward as much gains as possible. So that's probably that's the key thing that I would imagine the ATO are concerned with. But there might be others that are close to the 3 million or just over, and they may be trying to bring it under. So look, I think from the ATO's point of view, they'll be concerned with both. They'll be concerned with both. But yes, I think that most people over 3 million will be trying, as much as they can, they'll be trying to increase the value of those properties in the financial statements. But again, as an auditor, it's like, well, no, its value is what it is, and not allowed to adjust it. So, yeah. Hope that answers the question, Sasha.
I think SMSFs are always that area, isn't it? It's like, wherever people think that they can be a little bit curly with it, they will. And, the ATO, which is in juxtaposition of the ATO's perspective, which is obviously the essence of today's conversation. So yeah. I'll let you continue, Chris.
Sure.
Loans and other.
Yep. I'll kick off that. I might just on something you said there, Sasha. I think it's important, because the ATO are going to be so mindful of this sort of, trying to increase the value, like the value. I would strongly encourage every accountant, to actually have a detailed work paper on their files, outlining the rationale for whatever valuation you've had. Now, even if you, there hasn't been a big increase from the 24 financials 25, it's entirely likely that they'll be looking at this sort of stuff, and down the track they will be sort of analysing the valuations, that or stuff that you've done. They'll be hitting up the accountant for that. So not just to make my life easier, but to protect yourselves. Have this detailed thing explaining, this is how we came to this conclusion, because we kind of get a couple of lines, blah blah blah, divide the income by 9%, and you need to have more than that. It's critically important with what you've just said there, Sasha.